What's up, everyone? It's Caddy with MoneyVest. So what a week in the markets, and I'm sad that it's over. Last week it was like we're glad it's over because it was so brutal, but this week, boy, oh boy, what a rally we have seen on the back of treasuries falling. So I'm gonna break down everything you need to know for this week, and of course next week we've got some more earnings coming out, and the following week we've got inflation data for the month of October. Today we got the unemployment numbers. We were live to cover those numbers earlier, so got lots to unpack. Hope you guys enjoyed this video and find it helpful. If you do, please make sure to drop a like and subscribe to the channel as well. I would really appreciate that. And the link to our Discord and Patreon is going to be down below. We are putting together a lot of amazing spreadsheets for you. This is all going to be data driven with actual numbers and evidence. And for that very reason, I actually want to bring up a quote from Jim Simmons. Jim Simmons, a lot of people actually don't know who he is. He was the founder of Renaissance Technologies. It's actually one of the best quant trading firms in the world. In fact, it has performed better than Warren Buffett, but since Warren Buffett has been doing it for such a long time, over 50 years, he's had a lot of time to compound to significant returns, whereas Jim Simmons and Renaissance Technologies didn't quite perform for a very long time, but the returns that they performed through their quantitative analysis was absolutely fantastic. And this right here is a book that I highly recommend people read. I'm going to be doing a summary and a review of this book, which is incredibly insightful, and that's The Man Who Solved the Market by Jim Simmons, launched the quant revolution as well. So one of his most famous quotes is, "The best decisions are often made with data and evidence, not just gut feelings." So what he's saying is that, look, gut feelings definitely do have their role and their part to play when it comes to investing, because sometimes it just feels right. But a lot of the times, majority of the decisions and the contribution of those decisions need to come from actual data and actual evidence to make it sense. Okay, and that's exactly why we're putting together so much research. And I actually put together another spreadsheet which goes over the NASDAQ's 200 simple moving average and the percentage of stocks trading above or below these levels. And this again is going to be part of our cheat sheet, which is going to go over the current read, the percentile that we're in, and the rareometer, which is going to be whether it's normal or rare in the markets, to see that number at around 32 right now is where it's at, and where does it fall in this table of percentiles, because it's going to help us really form and base our decisions. And since we were kind of on a lower reading up until yesterday, it's actually one of the reasons I actually bought more VUG shares, Vanguard Growth ETF, which is a NASDAQ 100. I didn't gravitate more towards TQQQ. However, hindsight 2020, that would have been a better decision, but the trade had already moved quite a bit, so I didn't want to go in with a less favorable risk-reward trade-off. Hope that makes sense, and I mentioned this in the Discord as well, and that's exactly why I basically bought in about $5,000 worth of VUG yesterday and mentioned that there's a possible lower high on the NASDAQ up to 13.6K, so 13,600. This was, of course, yesterday. This was the weekly chart. Very nice candle, and if you come over to where the VIX pretty much ended up, or the NASDAQ ended up today, 13,478. The lower high pretty much got pinged right at that level, and the high for the day, 13,520. Now, is this going to continue? We will talk about that later in the video, but this is really the whole idea, is kind of looking at trading opportunities, looking at volatility, technical indicators, market breadth, to better position ourselves for success and putting the odds back in our favor, because as we know, you're competing against institutional traders, you're competing against high frequency traders, algorithms, so many things. It's optimal to have that data-driven approach, and of course trade with proper, precise risk-reward trade-offs. So link's going to be down below if you want to be a part of our community. Again, you get access to all the benefits, all the spreadsheets, everything's going to be included, as well as our community access. We're averaging about over 1,000 messages per day, so you will be able to get into like insights from some very, very high advanced traders, investors from all around the world. So we'd love to have you on board. Link's going to be down below. So, strategist warns, don't trust the stock market rally. This is Salman Ahmed, Global Head of Macro and Strategic Asset Allocation at Fidelity. He says that, in short, we don't believe in this rally. We've had a tough later part of summer. There was focus on tightening of financial conditions, what was coming for the key central banks. Nothing has changed in a fundamental manner, so we still think that we are going to see more problems ahead as the higher for longer rates profile beds in and starts to impinge on the real economy. Now, to some extent, I do kind of agree. I think if rates stay higher for longer, there is a possibility that the softening in the labor market continues, we continue to see some contraction in the economy, which eventually leads to a potential recession. We don't know if that's going to happen, but it is a possibility that higher rates for longer creates this environment of economic contraction and recession type environment, which the market's not going to like very much. I think we'll have to see a big repricing in the market. That's exactly why I think it's still, in my opinion at least, what I'm doing is I'm still sitting majority on cash, not majority, in other words, 20-25% in cash, earning that 4 to 5%, and I'm not going crazy in this market right now. Still dollar cost averaging here and there, but still holding a significant chunk of cash, more than usual, because the market, of course, is seeing a technical rebound on the back of pricing in significant amount of rate cuts next year. So 4 rate cuts are priced in next year, and now expecting no more hikes in 2023. So in other words, pause, and then starting in May of next year is when they are expecting cuts from the Federal Reserve. Along with equities, U.S. and European government bonds have also rallied this week. So we did see a significant momentum for the bond market as investors interpreted the Federal Reserve's rate hold as surrounding commentary as a sign that rates have peaked and cuts are within view. And that was despite the Fed Chair Jerome Powell's insistence that the further hikes were not off the table. And if you look at Chair Powell's speech, it had a hawkish bias to it. There's no doubt about it. Jerome Powell wanted to sound tough, but the markets were basically calling him on his bluff, and they still rallied on the back of very, very strong momentum. Now, U.S. payroll increased by 150,000, less than expected. We this in our previous video. Manufacturing payroll did decline significantly. Government and construction jobs also did decline 23,000, which was also a pretty significant decline with both manufacturing and construction, and unemployment rate rising to 3.9%, all of which suggesting to the weakening labor market, the weakening potential economic conditions as well. And as a result, the market cheering this, and the treasury yields also falling down as well. Chinese Tesla rival NIO cuts 10% of their workforce as CEO predicts intense competition. This is something that we have talked about in our previous videos, that NIO needs to focus on profitability. And I think cutting 10% of their workforce is going to help save some expenses and focus on what is actually working for the company, right? This is very, very important. Look, I've talked about this in our previous videos. A higher interest rate environment, this is really what's going to dictate who survives and who goes under. It's that simple. It applies to investors, it applies to consumers, it applies to businesses, it applies to everybody. When things get tough, it all comes down to who is going to survive, who is going to push through, or who is going to quit, throw in the towel and call it a day. That's what it comes down to, right? So people who are well capitalized, people who haven't stretched themselves too thin, people or businesses even who haven't taken on too much debt, businesses that have a lot of cash, businesses that have profitable growth, businesses that have good management teams to survive this downturn are the only ones that are going to be left after the dust settles. That applies to everyone, not just businesses, even individuals, even consumers. So now is the time for everyone to look at their financial situation, make sure that you are controlled in expenses, in your debt levels. Interest rates are modest, right? You're not paying crazy 7-8% for mortgages or auto loans or whatnot, to kind of reposition a little bit so that as we progress over the next couple of quarters, we are in better positions to take advantage of when deals present themselves, because they will happen. There will be deals. There will be opportunities. It happens every single recession. I'm not saying there will be one, but we need to be prepared for in case there is one. So there's a huge difference there. So this right here is the daily chart. The markets did fade towards the end of the day, so we did see a bit of a pullback, but semis pushing higher very, very nicely. We did have Google, Meta pushing up. Amazon, Tesla was mostly flat. Microsoft very nicely up. Apple selling off on the back of earnings. But this is the past week, right? Over the last 1 week, so much liquidity going back into equities, a lot of momentum. Fortinet had a massive green candle on a red day today. So just props to people who actually bought in the morning, before the market opens or at the market open, because it did rally about 10-11% intraday. Still down 12%, but intraday was a very strong move to the upside. But overall, very, very strong green day. I mean, lots of momentum coming in. All 11 sectors in the last 1 week are green. So a lot of liquidity flooding back into the equities and even the bond market, right? So it's possible that we did see a lot of money flow out of money market funds over to equities and the bond market, considering that the yields started dropping, and that creates that risk-on environment in the markets once again. And money market funds are really risk-free, but the rate of return is obviously much lower compared to the riskier assets such as equities, and especially when you consider bonds, that offers an asymmetric risk-reward trade-off considering how high the yields are. And we did a poll earlier talking about whether the yields have topped or not. Of course, 2/3 of people voted for the fact that the yields may have potentially topped. The other third basically mentioned that they're going to go higher, over 5%. Of course, time will tell whether that happens or not. But the interesting thing is that money is flowing back into the market. And it's broad-based, That's what's interesting, is that it's broad-based. It's not M7, it's not big tech, it's not large cap that's actually driving the move higher, but it is other sectors participating. It's broad participation in this rally. Lumber prices, soybean, coffee, all pushing higher with volatility here. Soybean, heating oil, everything pulling back. Bitcoin just over 34,000, Ether just over 1,800 once again. So, next week's going to be quite fun between the bulls and the bears, because I'm going to tell you right now, there will be a battle. There will be a big battle next week, because we are once again coming up to this lower high. This is about as picture perfect as it gets. Like, we are perfect at this level, at this lower high, and resistance all the way up to 13,800. So, that's going to be that next level. In case we get up to that level, that would already mean a higher high on the NASDAQ. But we've got first a lower high to watch over here inside this downtrending channel. And then in case we get a breakout above this, next target is going to be at 13,700. So those right there are going to be a couple levels to watch on the NASDAQ moving forward. Talking about the S&P, same exact thing. Take a look at where we pinged at 4,400 almost, 4,375. 27 points off. So this right here is the lower high. And, in case we see a breakout above this, next target, 4,400. So we're going to have to cover those 27, 23 points. And this right here is going to be that next resistance. And in case we get a breakout above 4,400, then we are looking at a higher high for the S&P 500 as well. So very, very nice move to the upside. This week was phenomenal. And really next week's going to be the real battle for the market, and whether we see that continuation or not. Talking about Apple here. So Apple, green candle on a red day. Still trading inside this downtrending channel, now coming up to that lower high. So very similar to S&P and NASDAQ. It's coming up to this lower high over here. And if it does get a breakout, $180 is going to be next to watch for Apple. In case we get a breakout above that, then there's some confirmation. There's confidence in this rally that, okay, bulls are strong. We're taking over. It's time to go back up. Folks, back to the previous targets from back in July. Talking about Amazon. Amazon has already started to break out from this lower high, lower low pattern. It's now starting to make a very nice higher high. So support level is going to stay put at 134, 135. Of course, the next target and resistance is going to be all the way up to 146 for Amazon. So that right there is going to be that next level to watch. Talking about Tesla, and Tesla here, back above $212 per share support. Our previous resistance, we broke out, and now it's acting as a support. And the next target and resistance is going to be at $240, and we also do have a little bit of a gap to fill over here for Tesla. So 240 is going to be that next level to watch as a resistance for this company, and support level is going to stay put at roughly around $212 per share. Talking about NVIDIA right now, NVIDIA on the day, very nice rally, 3.4%, back up to 450. And the next resistance and target is going to be all the way up to this right here. That's going to be the level closer to $474, $475 per share. Support level is going to stay put at close to $400. So that $75 range is really where NVIDIA has been trading. Advanced Micro Devices, huge breakout, back above $112, making a new higher high. What a strong rally. This right here, $181 billion market cap now, and getting up to this previous resistance once again. In fact, almost breaking out, got up to as much as 113, but really just kind of hovering around 112. 4% green day, very nice move to the upside, and somewhat making higher highs as well. Now, it definitely is starting to get a little bit more on the overbought side. Not quite there yet. 64 is where we're at, so definitely keep a close eye on that for Advanced Micro Devices. I'm just going to copy and paste the MACD as well. Just wait for a second. There we go. So again, our RSI, MACD, both of them pushing higher very, very nicely for Advanced Micro Devices. So keep in mind, not there yet, but definitely pushing higher very nicely. Talking about PayPal, and PayPal here on the day, holding up really nicely, 1.89%, back over $56. This right here is pretty much the resistance at $56, $57. So we'll continue to monitor this level right now. If you do get a breakout above this, next target is going to be 65. Slowly and steadily, we're making progress on PayPal. Visa here, green day, but a red candle. So it does suggest there was some profit taking. RSI, once again, getting up to that level, not quite overbought yet. But next resistance and target is going to be $250 per share for Visa. And of course, support level is going to stay put roughly around $228 per share for the company. So very, very nice move to the upside. It's pretty much rallied from 229, about almost 7% from those levels. Talking about Meta Platforms and Meta here. consolidating sideways at resistance, so not really moving all that much. So it's just been trading sideways at that resistance at 314, 325. Support level is going to stay put at 293 all the way down to as low as $274 per share for Meta. So just a lot of consolidation in that sideways range, pretty much at 275 to 325 in that $50 range for Meta platforms. Talking about Netflix, and Netflix here continues to make a move 1.8% higher, and next target and resistance is going to be at 452. So this right here is really going to be that level to watch for Netflix. Huge gap to fill over here. Support level is going to stay put down to $348 per share for Netflix. It's a little bit under $190 billion market cap. Google, on the other hand, very nice move to the upside, also 1.3%, somewhat filling this gap, so we're going to close it slowly and steadily, and the next resistance really is going to be closer to $139 to as much as $144 per share for Google moving forward, and support level is going to stay put down to 126, down to as low as low 100s, 117, 120 for Google. Microsoft here, on the other hand, also with a very nice breakout, higher highs and higher lows, very nice, and next resistance is going to be at 366 for Microsoft. So that right there is going to be that next level to watch for this company moving forward. And last but not least, we got Costco and Enphase, and Costco here pushing higher very nicely. Next resistance, we are pretty much coming up to that resistance at 560 to as much as $570. So that $10 range is going to be that level to watch for Costco. Support level is going to stay put it down to 531. And finally, we got Enphase Energy. Doji candle a little bit, 2.3% higher on the day. Support level is now going to stay put at 79, close to $80 for Enphase, and the next support is going to be 92. We've got a massive gap to fill over here for Enphase as well. So this right here is going to be that gap, resistance all the way up to $92. Like I said, support level 79. Very, very oversold. So it's possible we do see a little bit of rebound back higher for Enphase. So bottom line is that lots of momentum coming up on the back of Treasury yields are dropping, but it's really going to come down to next week with a big battle between the bulls and the bears to see whether the markets can break out of this resistance, or are we going to see the rally sort of fade starting next week, consolidate, and roll right back down? Let me know in the comment section down below. What do you think? As always, if you enjoyed this video, found it helpful, make sure that you drop a like, subscribe to the channel, and don't forget to join us on our Patreon and Discord. I will be posting a lot of private members-only videos this weekend, going over the technicals for Magnificent 7, going over our spreadsheets and our trade ideas, and the intrinsic value spreadsheet will also be updated and shared with all the members this weekend. As always, happy investing. Link's going to be down below. I'll see you all in the next video.